So today we're going to look at the concepts of accounting. The concepts of accounting are essentially the rules that are put into place to ensure that all accounts are prepared using the same methods. They are actually part of UK law, part of the Companies Act of 2006, also put into law by international accounting standards. So no matter where you go in the world, accounting concepts will be used to put accounts together. Now, the concepts hopefully will allow us to show a true and fair view of the financial position of the business. When we put together our accounts, they're put together for stakeholders. And when we communicate our financial information to stakeholders, we must show a true and fair view. In the auditor's report, that's the report of the independent accountant that will check all limited company accounts. The final line in the auditor's report will be that the accounts do or do not show a true and fair view of the financial position of the business. We obviously want to make sure that we are showing a true and fair view, that we're not hiding anything, nor are we putting together our accounts in a way that could be deemed fraudulent, nor are we putting together our accounts in a way that could be deemed negligent. And by that, I mean badly. So we must follow the accounting concepts, these rules, to ensure that our accounts are put together properly. So what you need to learn is the names and the details of each accounting concept and be able to apply them to given situations. So we're going to go through a few today and make sure that you can recognize them and apply them to given situations. Now, the first concept is going concern. Now, this is one of the most important of all accounting concepts because it's all about making sure that we think that the business will trade for the foreseeable future. So when we do our accounts at the year end, we ensure that our accounts roll forward. That's why we always have brought down figures in our accounts, right? Because they're brought down from previous years and we bring them down into the next year as well. Because we assume that the business is going to continue to trade. And that means that the assets shown in the accounts are shown at book value. So, for example, with non-current assets, we show the cost minus the depreciation, find the net book value, or we show the debtors minus the provision for doubtful debts to show the net value of the debtors. Going concern is just making sure that when you prepare your accounts, that you prepare them so that people understand that you're going to continue trading next year. And the value of your assets is what they are worth to you, not what you could potentially sell them for. And that tells people more about how much your business is actually worth. So always show your assets at cost minus any provisions, and that'll tell you your book value. Part of the going concern concept that you're going to trade for the foreseeable future. The next concept you need to know is the consistency concept. And this says that the same principles of constructing the accounts must be used from one year to the next. So that could be depreciation or doubtful debts. And once you've decided on a method, so if you buy a vehicle and you decide to depreciate it in the first year at 20% straight line, then you're going to have to depreciate that asset at 20% straight line for the remainder of that asset's life. Once you've chosen a method of depreciation, then you have to stick to it throughout its life. You must be consistent in your approach to the accounts. This one's very important as it allows comparisons between years. If people change their depreciation method each year, you wouldn't be quite sure what the asset's currently worth or why it's gone down so much. So you must make sure you're consistent in your methods each and every year. You can choose your depreciation method yourself. You can choose your percentage of doubtful debts yourself. But once you've chosen, you've got to stick to it unless there's a really, really good reason to do so. So if you're depreciating a car at 20% straight line, you depreciate it for its life, unless something happened which meant that that vehicle had suddenly lost a lot of value. For example, electric cars replacing diesel cars. Flying cars replacing road cars. That'd be a good reason. So once you've chosen a method, stick with it, be consistent. Part of the consistency concept. It's easy for you to say, but not me, apparently. Okay, next one, probably the most important one that we'll look at is the prudence concept. Now, the prudence concept is about taking a conservative approach to your accounts, not overvaluing them. Now, by conservative, we mean almost negative view. So we take a dim view of our accounts. We don't want to overvalue anything. For example, stock is valued at the lower of cost or market value in the accounts of the business. I'm going to come back to that in a second. And the business must not overstate profits or the book value of the business. Now, I've just said that stock is valued at the lower cost or market value. Now, the one that I really, really want you to learn is that we must value stock at the lower of cost and net realizable value. That is a sentence that you need to tattoo on the inside of your eyelids so that you see it when you sleep. Because it comes up quite a lot in the exams. Please do not get your eyelids tattooed. I'm aware that I've just said that on microphone and it's going to be going on YouTube. Please do not do that. It was only a joke, but you must remember this. It's very important. So we're going to value our stock at the lower of cost and net realizable value. And we're going to take a negative view of our accounts, making sure that we don't overvalue anything. Some key terms. So cost is the original purchase price of the stock. Realizable value is what the stock is sold for, so the market price. Repair cost is getting stock back into saleable condition. That usually happens when stock has been damaged. You need to repair it so that you can sell it. So our net realizable value is the selling price of the stock minus the repair cost. Very important key terms for you to learn there. So remember, we value stock at the lower of cost and net realizable value. So ABC has a closing stock of £45,000. They count up the stock and they realize that 200 items are damaged. At cost, these items are £100 each and they can be sold on the open market for 120. In order to get the 200 items into saleable condition, each item would need to be repaired at a cost of £35 each. So we've got to make sure that our stock valuation is correct now that we've got this extra information. So at cost, the items were £20,000, 200 times £100. Total sale price would be £24,000, 200 times the 120 sale price. Repair cost is £7,000 on those damaged items. So we can say the net realizable value of our stock is £17,000. The selling price is £24,000 minus the repair cost £7,000. Now, we want to make sure that we value our stock at the lower of cost and net realizable value. Net realizable value is £17,000, cost is £20,000. So we're going to use the £17,000 valuation. So from our original £45,000 overall stock valuation, we're going to take away that cost of £20,000 because that's no longer appropriate. We're going to use the lower cost of £17,000. So our stock valuation drops from 45 to 42,000. We've taken a conservative valuation of our stock, making sure it's the lower of the two items. And that 42,000 is the valuation of our closing stock on the income statement and the stock that we would use on the statement of financial position. Comes up all the time. It's worth tons of marks. Lower of cost and net realizable value. Try and get it remembered. Next concept is the accruals concept. We've already done accruals. We know all about accruals. We know how to debit. We know how to credit. We know how to do accruals on the balance sheet. We know how to do prepayments on the balance sheet. The accruals concept basically just puts that into the rule book, into the law. And the accruals concept basically states that revenues and costs are recorded in the accounts when they occur, not when the cash is received or paid. Also, revenues and costs are matched against each other for the same financial period. So that means when we've got our income statement and it says at the top, income statement for ABC Limited for the year ended 31st December 2020, that all the costs and the revenues within that income statement happened in that time period. In the year ended 31st December 2020. So the accruals concept makes sure that everything on your income statement relates to the time period stated in the type. So we have to make adjustments in the accounts for amounts owing and for prepaid amounts as well. The accruals concept also allows us to put those prepayments and accruals onto the balance sheet. And it's the reason why bad debts and doubtful debts are recorded in the time period in which the original sale was made. So particularly with doubtful debts, they're only debts that we think might go bad, but we record the deduction from the debtors in the year in which the sale was made because of the accruals concept. So we're recording that they're reducing the debtor, that even though we've made the sale, we're going to record that we might not receive the money because of the accruals concept, because we want to match that expense to the time period in which the sale was made rather than when it eventually goes bad. A couple of easy ones now. First one is objectivity. This is all to do with removal of bias. So being objective about something means there's evidence to back it up. So the accounts should be prepared using accounting methods that can be agreed and only including figures which can be backed up by source documents. A source document states a figure on it. That's the figure you've got to use. You've got to be objective. Another example might be assets. Right, so I've got a car, it's worth about £1,000, right? I love that car. To me, it's worth much more than that. But in my account, I would have to put it down as £1,000 because that is an objective cost. That is actually what it's worth, not what I think it's worth. I can only put down what I know to be true. Another concept is the duality concept, which we've spoken of before as well. And that states that each entry into the accounts records both sides of the transaction, that there must be double entry for every single transaction. That's why I keep going on about it. It's because it's the law. Another one is that the money measurement concept, and that states that all transactions in the accounts must have a monetary value. So you can't put things in the accounts that don't have a monetary value. For example, your staff. You can't put staff into your accounts. They may be brilliant. They may be the best staff in the world. However, as they don't have a monetary value attached to them because they're people, you can't put them into the accounts. Okay. Another important one is the realization concept. This is the point at which a business earns a profit. Now, this is all to do with the risks and rewards of ownership. Only when the risks and rewards of ownership are passed to the new owner can you class a sale as being made. So the best way to think of it is with an egg, right? With an egg. Now, if I sell eggs and you buy an egg from me, from my shop, you can pick up that egg in the shop, right? You've not yet bought it. The risk rewards of ownership are still mine until you paid for it and walked out the shop, right? Because up until the point where you paid for it, that egg could hatch and become a dragon. It becomes a dragon, I'm going to want to keep it. I want to keep the rewards of ownership to myself. Or you could drop it. We all drop things in a supermarket and not paid for them, haven't we? So, yeah, we have. You don't want to pay for something that you can't actually use or you haven't actually paid for yet. So, it's all to do with the risks and rewards of ownership. So, not until that product is passed to the new owner, they have paid for it and taken ownership of it, can you class that sale as being made. All right. Now, an example we've got here is Danny's got a year end of 31st of January. He receives an order on the 30th of January, the delivery date of 2nd of February. Now, Danny can't include the sale until the 2nd of February as the goods still belong to him. So it's really, really important that you make sure that you know that the risks and rewards of ownership are still Danny's up until the point when those goods are delivered on the 2nd of February. Think of it like an Amazon order. When you make an Amazon order, the risks and rewards of ownership aren't yours until the driver drops them off at your house. If the driver never drops them off and you never took ownership of those goods, you can ring Amazon and get your money back or a replacement or whatever. It's not until the driver's dropped it off and you've closed the door. Once that happens, the risks and rewards of ownership are yours. And at that point, that is when Amazon can class the sale as being made. Now, within the realization concept, we often see questions on sale or return. It's not an awfully common thing that's used in the business world. It is used quite a lot in newspaper sale or return. Now, sale or return is all to do with giving goods to a customer, but not actually selling them up until the point that the customer sells them themselves. So just to go back to the newspaper example, if you go to a newsagent's first thing in the morning, you'll see loads of newspapers piled outside, okay? They'll take them in and they'll count how many newspapers they've got. At the end of the day, any unused newspapers, again, are left outside the shop. Now, those unused newspapers are returned to newspaper publishers and they're not paid for. Newsagents only pay for the newspapers that they actually sell because they buy them on a sale or return basis. If they don't sell them, they get to return them. So therefore, the risks and rewards of ownership are never actually the newsagents. They always belong to the newspaper publisher because at any point they could have all those newspapers returned to them. So only when the customer has confirmed the goods have been sold to a third party can the company include the sale as being complete. So when they know for certain that they won't be getting the goods back. So we've got Mohammed here. He's got stock at 31st December of 89,500. On the 15th of December, Mohammed sent £3,000 worth of goods to Fiona on a sale or return basis. Fiona has yet to confirm that she's sold the goods. Now, as Fiona can legally return those goods at any time, they still belong to Mohammed. Fiona hasn't paid for them yet. Fiona hasn't confirmed that she's taken ownership and sold them, so she can legally return them at any time. So although the goods may not be in Mohammed's warehouse, they still belong to him. And therefore, the value of his stock is no longer 89,500. He has to include those £3,000 worth of goods sent on a sale or return basis. So his stock figure is actually 92,500. Business entity concept is all to do with separating out the owner from the business. So the owner of a business and the business themselves should be seen as separate legal entities. So if the owner makes drawings, that will reduce his capital or her capital. It's 2021 after all. So for example, if you own a business and you decide to buy a company car, that's absolutely fine. You can buy a company car as long as it is used for the business. If you decide to buy a caravan for that company car to take your family on holiday and pay for the caravan out of the business's money, as that caravan isn't used for business purposes, that will be classed as a drawing against your capital. If you run your business from home, you can't put your Sky TV bill through the business because it's not part of running the business on a day-to-day basis. So basically, any money spent by the business for the personal use of the owner must be classed as a drawing. Cost concept states that transactions are recorded at their original cost, and the final accounts will show all the transactions at the historic cost, similar to the objectivity concept. We're just making sure that all of our transactions are recorded from the source document at their original cost. We are, of course, under the cost concept, allowed to depreciate items, and we're allowed to use doubtful debts in order to reduce the value of our debtors. However, we must also show the original cost of the asset within the financial statements. Finally, we've got materiality. Now, materiality is all to do with the value of a transaction and whether or not we class it as an expense or a fixed asset, a non-current asset. Now, this depends on the size of the business and whether or not something is of material value. So, for example, if a multi-billion-pound corporation buys a laptop computer at £300, that's not really material to them. And they could actually class that as an expense if they want. Whereas for a small business, £300 might be quite a considerably large asset and should be included on their balance sheet. So it really does concern whether the business is big or small as to whether you include it as an asset or an expense. The rule that I was always taught, I haven't written on the PowerPoint, but the rule that I was always taught about materiality is if something is of significant enough value to alter your perception of the balance sheet, it should be included on the balance sheet. If it's not going to make much of a difference to the value of the balance sheet, then it should be classed as an expense. Now, another example I can use here is things like paper clips, right? Businesses can own thousands of paper clips. They can own hundreds of pounds worth of paper clips. And we know that the definition of a non-current asset is a resource used to generate profit and can be kept for longer than a year. You can keep a paper clip for longer than a year. You can use it to generate profit. But it's going to take you forever to value all of your paper clips. So if an item is a small item, but part of a larger group of small items, and it would take you a long time to count them and to value them, include it as an expense, not as a non-current asset. So materiality is all to do with whether or not an item goes on the income statement as an expense or on the balance sheet as a non-current asset. If it's large enough to affect the balance sheet, put it on the balance sheet. If it's not going to make much of a difference to the value of your assets in the balance sheet, then class it as an expense.